Hey, welcome! Today we are diving deep into the UAE real estate market. But, we're not just going to be scrolling through listings. We're going to build a professional framework to actually evaluate deals. And we're basing this on the work of economist Dr. Pooyan Ghamari. It's all about making that critical shift from just accessing opportunities to building an architecture for your success. So here's what's on tap. We're going to start with what we're calling the core paradox of the UAE market. Then we'll dive into Dr. Ghamari's three-layer evaluation framework. From there, we'll walk through how you go from analysis to actual acquisition, learn how to protect your capital during the deal, and finally, see the incredible professional advantage this whole system gives you. All right, first up, the UAE property paradox. This really gets to the heart of a strange problem that a lot of investors run into. So why is it that having access to more information doesn't always lead to a better investment? Kind of counterintuitive, right? This quote from Dr. Ghamari just hits the nail on the head. We're absolutely flooded with property listings, flashy marketing. It makes it feel like amazing opportunities are just everywhere. But finding real clarity on the actual value, the hidden risks, the true potential, well, that's a whole different story. Dr. Ghamari has a name for this. He calls it the structural gap, and it's that huge disconnect between what you see on the market, all those shiny listings, and the verified real quality of what you actually get. So many investors mistake availability for suitability, and believe me, that can be a very, very expensive mistake to make. This really shows the two different paths an investor can take. The marketing-driven one, it's all about speed, emotion, and that fear of missing out. But the analysis-driven path, that's systematic. It prioritizes verification, positioning, and what really matters, long-term cash flow. That second path is specifically designed to protect your capital by slashing your risk right from the get-go. So how do we actually fix this? How do we bridge that gap? Well, that brings us right to our second section, the three-layer evaluation framework. This is the blueprint for success. Okay, so the framework itself is built on three really clear layers. First, you have to analyze the overall market context. Second, you evaluate the specific location positioning. And third, you conduct a deep forensic asset verification. This is the high-level roadmap that every single serious analysis should follow. Layer one is all about the big picture. Before you even look at a single apartment, you have to understand the market itself. Are properties actually selling? Is supply swamping demand? Are developers actually finishing their projects on time? Getting this context right is absolutely essential. It's step one for a reason. Okay, next, we zoom in on the location. And the key here is to be systematic. You use something like this location value matrix. Think of it like a scorecard for a submarket on things that truly drive value, like accessibility, amenities, and maybe most importantly, the risk of oversupply. This is exactly how you figure out why two properties with the same price tag can have completely different futures. So you've analyzed the market, you've analyzed the location, and that leads to the million-dollar question, right? How do you actually confirm that what the developer is telling you is true? How do you uncover those hidden costs that nobody talks about? And that brings us to layer three, asset level verification. So what's with this number? Well, in one real-world case, a deep dive on a property revealed that its service charges were set to increase by 15% annually. A fact like that completely torpedoes the investment math, and it's the kind of thing you only find by digging this deep. All right, with our framework firmly in place, let's make the move from analysis to acquisition. And the very first step is knowing exactly who you're buying from. Let's be clear, not all developers are created equal, and this tiering system makes that obvious. A Tier 1 developer? Sure, they command a premium price, but that premium buys you quality, better financing, and higher resale value. That Tier 3 developer might offer a tempting discount, but that often comes with a whole lot of baggage, higher risk, lower quality, and a potential hit to your property's value down the line. So how do you manage that risk? With a staged process. Think of it like a series of gates or checkpoints. Before you commit any serious money, you do a foundational check. After a small commitment, you launch a deep investigation. And right before handover, a final, thorough inspection. Each one of these stages is an off-ramp if you find a problem that's just too big to ignore. Okay, now we get to the real architecture of the deal itself. This is all about how you structure the actual transaction to minimize your financial risk and, critically, maintain control of the process. Just look at the difference here. A standard payment plan has you paying on fixed dates, whether the work is done right or not, and it gives you very little protection.
But an enhanced structure? It ties your payments to results. Money is only released when milestones are verified, and some is even held back in escrow for defects. That intentional friction in the process, that becomes your safety net.
And protecting yourself goes way beyond just the payment plan. Title verification is not just a box you check. A professional deep dive looks for things like hidden liens. It validates the developer's authority to even sell the property, and it analyzes the property's sales history. I mean, can you imagine finding out a property has been sold 3 times in 18 months, each time for a lower price? That's a massive red flag that a simple registry check would completely miss.
All right, let's pull all these different pieces together now. We're going to zoom out from the tactics of a single deal and look at the long-term strategy of building a portfolio that has a real, sustainable professional advantage.
This is what investment-grade consultancy is really all about. And let me be clear, it's not sales. It's about providing a system that levels the playing field of information, that reduces the risk of things going wrong, and most importantly, that ensures every single deal you do lines up perfectly with your own personal financial goals.
So how does that alignment actually happen in practice? It happens with a tool like this, the Investment Mandate Matrix. This is what translates your big, broad goal, like, say, capital preservation or maybe yield optimization, into a concrete, actionable plan that tells you exactly what kind of property to look for and where to look for it.
And finally, please remember, the work does not stop when you get the keys. Preserving your investment's value is an ongoing job. Proactive preventative maintenance isn't a cost. It's an investment with a proven positive return. Focusing on high-quality tenants saves you a fortune in vacancy and damage costs. And always manage the property with an eye on a future sale, so you have the flexibility to exit when the time is right for you.
So we'll leave you with this one final thought. As you look at the real estate market, just ask yourself this. Is your strategy built on simply having access to deals you see online, or is it built on a solid professional architecture that's designed from the ground up to protect your capital and achieve your goals? The difference between those two, well, it's everything.